Today we're going to unpack what has been a dramatic and sudden shift in the global cryptocurrency market. On November 21st, we witnessed a major sell-off across virtually all major crypto assets. Bitcoin dropped more than 5%, breaking below $82,000 for the first time since April, while Ethereum fell below $2,800. Other major altcoins, including BNB, DOGE, and ADA, also fell sharply. Overall, the sentiment turned broadly risk-off, with traders and investors reacting to both macroeconomic developments and market-specific dynamics. This sell-off is not just a minor correction. It is part of a larger narrative that investors need to understand. In recent months, the crypto market has been influenced by several factors simultaneously: global economic policy uncertainty, interest rate expectations, tech stock performance, and internal crypto market cycles. Understanding the interplay of these factors is critical for anyone who wants to navigate crypto safely. Whether you are a long-term investor or an active trader, today we'll go slide by slide to break down the main drivers of this sell-off. The massive liquidations that affected hundreds of thousands of traders, macroeconomic pressures, including shifting expectations around rate cuts, the influence of large whales and their selling behavior, and finally, how analysts are interpreting this as either a capitulation event or a potential opportunity for a final dip. We'll also contextualize this within the broader 4-year Bitcoin cycle, which has historically dictated patterns of booms and corrections. By the end of this session, you should have a clearer understanding of why this sell-off happened, how it fits into the larger market dynamics, and what potential next steps for the market could be. Let's start with the first slide, the overall sell-off. On November 21st, the cryptocurrency market experienced a significant drop, sending shockwaves through traders, investors, and institutional participants alike. Bitcoin, the market's flagship asset, fell over 5%, breaking below $82,000 for the first time since April. This is important because $82,000 had been a psychological support level, and once it broke, it triggered further panic selling. Ethereum, the second largest cryptocurrency by market capitalization, also dipped below $2,800, reinforcing the negative sentiment. Other major altcoins, including Binance Coin, BNB, Dogecoin, DOGE, and Cardano, ADA, all followed the trend, highlighting the broad-based nature of the sell-off. It wasn't confined to a single asset or token type. This was a systemic reaction. The overall market sentiment quickly shifted to risk-off, with investors exiting positions, reducing exposure, and reallocating capital to safer assets. The reasons for this initial drop are multifaceted. Investors were reacting to macroeconomic concerns, particularly around US Federal Reserve policy, which we'll dive into in a later slide. There were also internal crypto market dynamics at play, including over-leveraged positions, concentrated risk exposure, and the psychological impact of high volatility after months of sustained growth. It's also worth noting that the sell-off was compounded by technical factors. Bitcoin's support levels, which had held strong in previous corrections, finally gave way under the pressure of large-scale selling. Many traders were forced to liquidate their positions, and automated trading bots amplified downward momentum. The combination of macro concerns, technical triggers, and trader psychology led to a cascade effect, making November 21st one of the more dramatic single-day sell-offs in recent months. Now, let's talk about the human and financial impact of the sell-off. Over the 24-hour period, liquidations reached nearly $2 billion, specifically $1,965 million. Long positions accounted for $1.828 billion of this, while short positions accounted for only $137 million. Overall, more than 403,000 traders were liquidated across global exchanges, meaning their leveraged positions were forcibly closed by the platform because they no longer met margin requirements. The scale of these liquidations is staggering. One of the largest single liquidations was a $36.78 million Bitcoin position on Hyperliquid. This underscores just how much risk was concentrated in certain high-leveraged trades. The combination of a volatile market and aggressive leverage created the perfect storm for these forced liquidations. It's important to understand the psychological impact here. Seeing hundreds of thousands of traders wiped out within a single day heightens fear across the market. It triggers a feedback loop. As prices drop, more leveraged traders are liquidated, which pushes prices even lower, which in turn leads to additional liquidations. This self-reinforcing cycle contributes to extreme short-term volatility. Moreover, these liquidations disproportionately affected retail and speculative traders, many of whom use high leverage to amplify gains during bullish periods. The lesson here is clear. Leverage can magnify both gains and losses, and in highly volatile assets like cryptocurrencies, risk management is absolutely critical. This day serves as a reminder of how fragile market sentiment can be, and how quickly it can shift from euphoria to panic. Next, we turn to macroeconomic pressures. The sell-off didn't happen in a vacuum. One of the most important drivers was a shift in expectations regarding US monetary policy. Previously, markets had been pricing in a high probability of Federal Reserve rate cuts in December. Fed officials, such as Hammack, opposed further cuts due to persistent inflation, while Goolsbee expressed unease about a December rate cut, signaling a more cautious approach. This created a data vacuum, meaning that investors had less certainty about future policy direction. Crypto markets, being highly sensitive to macroeconomic signals, reacted sharply. When rate cut expectations cooled, it signaled to investors that liquidity might be tighter than anticipated, making riskier assets like cryptocurrencies less attractive. Additionally, US tech stocks, which are closely correlated with crypto markets, experienced significant declines during this period. This added another layer of downward pressure. The combination of tightened monetary policy expectations and tech stock weakness created a perfect storm for a broad-based risk-off move. In short, macroeconomic uncertainty increased market anxiety, and crypto markets, known for their volatility and speculative behavior, reacted strongly. Investors became more risk-averse, taking profits and reducing exposure to leverage. This slide underscores the importance of understanding macroeconomic context when analyzing crypto price action, as global interest rate expectations and market sentiment are deeply intertwined with crypto performance. Now let's consider the influence of whales and market cycles. Whales, large holders of Bitcoin and other cryptocurrencies, have an outsized impact on market dynamics due to the size of their holdings. Since September, analysts observed that whales have been selling heavily, offloading over $20 billion of crypto assets. These moves often signal the start of a risk-off phase or correction, and can trigger additional panic selling among smaller investors. Adding to this, CoinShares and other analysts cite the 4-year Bitcoin cycle as an important framework for understanding this behavior. Bitcoin historically follows a repeating pattern: 2 bullish cycles followed by a corrective autumn phase. This phase often aligns with broader market downturns and heightened volatility. According to this theory, we are currently in the autumn phase, meaning that seasonal and cyclical forces are contributing to selling pressure. This combination, fear-driven whale selling and structural market cycles, creates a self-fulfilling prophecy. Traders anticipate corrections based on historical cycles and act accordingly, accelerating market declines. Some analysts recommend profit-taking ahead of a potential crypto winter, which would allow investors to lock in gains and reduce exposure during a volatile period. This slide highlights how psychological, structural, and behavioral factors intersect in crypto markets. Unlike traditional equities, where institutional activity dominates, crypto is a market where large holders, small traders, and cycles interact in highly visible ways. Understanding whale behavior and cyclical patterns is crucial for anyone navigating these markets. Finally, let's look at the contrasting analyst perspectives. Morgan Stanley takes a bearish view, suggesting that Bitcoin follows a 3-up, 1-down macro rhythm. In this framework, the current downturn is part of a predictable phase, meaning that the market is entering what they call the crypto winter. Investors should prepare for extended periods of weakness and lower prices. In contrast, Standard Chartered holds a more bullish interpretation. They view the current sell-off as the third major correction of this cycle, meaning it could represent a reset rather than the start of a long-term decline. Valuation metrics, such as price-to-book ratios, have reset to extreme lows. Strategy: PB approximately 1, suggesting that capitulation may be largely complete. From this perspective, the market is potentially poised for a rebound before the year ends, making it a strategic entry point for long-term investors. The market now presents a paradox. On one hand, investors want hypergrowth in crypto infrastructure and applications to justify high valuations. On the other hand, fear of unsustainable growth drives anxiety about a bubble collapse. Bitcoin and other major cryptocurrencies now act as a Rorschach test. Bearish investors see systemic risk and overvaluation, while bullish investors see a temporary correction and opportunity. A notable quote summarizes this tension. "This may be the last time Bitcoin drops below $100,000. It captures both the fear and hope that define investor sentiment in this market. In essence, whether the market has capitulated or is entering a final dip depends on one's interpretation of cycles, macroeconomics, and risk appetite. Investors should monitor market dynamics closely, consider both fundamental and technical factors, and prepare for continued volatility. In conclusion, this crypto sell-off highlights the unique combination of leverage, macroeconomic sensitivity, whale influence, cyclical patterns, and investor psychology. By understanding each of these components, market participants can make more informed decisions and better navigate one of the most dynamic and volatile asset classes in the world today.